Good evening, friends. As we gather together here to discuss one of the most topical areas in finance in India today, it's the Insolvency and Bankruptcy Code and the process and the crucial part of this process as we are. I compare this to almost like a Bollywood movie which got started about a year ago, and we've probably now seen in the last few weeks and months some very interesting scenes, and maybe we are at intermission time. So as we look at from here, I think we are in a very crucial phase where a lot of critical aspects, and I think Luca rightly pointed out to many of them, will get clear over the next 6 months. And therefore, I think the time to watch how this whole thing shapes up is between now and June. And in many cases, you're going to see this where the resolution period is coming to an end. There will be some extensions and a lot new filings happening. The big policy issues coming around, including the challenges between Finance 101, which was the basis of the law, versus the politics and the policy changes which are now playing along with Finance 101. And like everything else in India, things evolve, meander, and finally we find the right landing, I hope, in this whole area. And we've got a very eminent set of people here in this group, including the first major regulator himself, and potential solvers, potential buyers. So we've got it all here in front of us, and in terms of setting the tone, as I've been instructed by Nirmal, I would follow the instructions to say that each of my colleagues here on this dais speak for about 5 to 7 minutes, give their initial points of view, then we will try and have a debate internally before we throw it open. So maybe I'll follow the simple sequence and continue immediately on my left. So Ajay, maybe you want to get off the mark first, because finally we want to see resolution more than anything else.
You know, it reminds me of my school days, and I was always lucky that my second name didn't begin with A, otherwise you were always called first. I used to always be in the end, but you've caught me on the wrong side. So I think let's understand where the environment is. I think today, as far as India is concerned, we can see that there is a good growth, economic growth taking place. GDP, I don't think there's any other country which can have real GDP growth of 7-8%, and therefore in nominal terms 12-13%. If I remove agriculture, because we are not talking about agriculture stress, actually business, industry or manufacturing services on an average grows 15%. So there are very few economies in the world. And even if you see the energy and enthusiasm of people here, I think I don't see that anywhere else in the world. So it's an environment which is a good environment to be in. But perhaps the biggest constraint to this growth would be the availability of finance. And the problem that we had before the movie started being shot or being released was the twin balance sheet problem. One is that you had banks which had really had capital which was stuck in assets which would have never yielded any results. And also companies themselves were so highly levered that you could not see any new investment taking place. So I think putting this, and all that has been done in the last 1.5, 2 years has been a tremendous, I think, move. And if you talk about reform, I think this is really a big bang reform, which is not, which people don't call it, but it is a huge one. And what I understand is that in such a short period, this has been done. There are no other countries which have had an experience that within 8-9 months that it has been actually put into place. So I think we should just congratulate all of you all here on my left for having done this. What has been done, I think, Renuka, you have gone with, but the fact is that today, even the 12 assets which have been recognized constitute, what, 25% of the total NPA of the banks. And just see the whole magnitude. Before these assets were recognized as NPAs, the banks used to provide 2%, and now suddenly it became 10 overnight. It can't have gone up 5 times unless and until something was being hidden and which had to come out. And therefore, I think this has been it's been a tremendous move. The fact that we've had now $32.5 billion in recapitalization has been also a big move. Again, I have some doubts about whether we'll really use this money well, because one is to provide the capital, but I think it's as important to see the management that will take adequate risk and which will do the lending, because I don't know what will happen otherwise to the capital that so much has been given. The ordinance we talked about for promoters and errant promoters has been a topic of great discussion, I think. But one thing it has brought, I think, and I read that today in the newspaper, I think some of them saying that the balance of power has shifted today from the promoter to the creditor. And I think to some extent it was required, because otherwise you had a situation where people were just the banks kept lending money, and it was not a loan, it was more like an equity. You always kept putting more and more loans and talked about as equity and never got a return, and there was no action being taken. There are issues on identifying promoters, but on the whole, I would support this, that this ordinance has been brought. Obviously, it has been too broad and it includes just about everybody, so we need to look at whatever changes are needed, and I know that Mr. Sahu and his team are looking at it. Also, as importantly, I think obviously the small and medium scale have to be left out, and we'll have to find some resolution on that. What will this do to a creditor? I was just thinking. I think it's the first time that...
Sorry. Carry on.
Am I? Okay.
No, you're okay. You're okay. Take your time.
Plus the 90.
Yeah.
Actually, that's true. I hope that we stick to this guideline of 270. When I see 180 plus 90, because when I see a lot of people who want to bring in capital, they're asking whether this limit will be extended or not. And I'll try my luck today and see whether you're doing it. But I think if you look at it till now, actually the financial creditors were also taking advantage. We've had so many schemes in the past, whether it's the whole, the SARFACI and the CDR and all that. That was just evergreening, and it was just bloating up the assets, if I may say. The fact that the RBI came down heavily and said that 50% you have to provide for the day you recognize or you put it into the NCLT and so on has been a very positive thing, I think. One of the important, I think, consequences of all this IBC is that I think more sensible lending will take place. There will be better, thorough evaluation of projects. And also, sometimes I find that in business, if you have a sick project or a weak project, then it is not run on economic terms. In other words, you could just, you can just sell at any price you want because you don't care. You don't care for profitability anymore. You just want to keep it running, so the banks keep funding. I've seen this in the textile industry for a long time. Sick mills continued for years and years, and that had an impact on even stronger companies, because after all, it's a competitive situation. You have to sell in the market. So this, I think, will make it clearer that weaker weaker businesses cannot survive, or they need a resolution to be done, and an early resolution, because we all know that usually when creditors would really kick the can for the next person to handle, or after 3, 4, 5, 10 years, people which were sick still continued to remain. So I think overall this will be good for the economy. We will see that there will be better project evaluation, there will be better projects being run. For the corporates also, I think it's the first time for corporates I see the impact that it is shifting, the balance of power is shifting in the hands of the creditors. And in some ways, it's a once-in-a-lifetime opportunity for many companies to consolidate. Actually, to consolidate and to make better businesses, and to see that businesses can compete on a global environment. The size, again, this is an opportunity for companies to accumulate assets and become bigger. It is also really a stern message for all of us in corporate India. You cannot take banks for granted anymore, which we used to do earlier. And that people have to bring in some equity in the long term. If there is a stress, the promoters need to bring in equity along with the banking. Otherwise, what was happening till now, it was only the bank which was giving in any stress equity, or a loan which was called equity. So I think this is a good thing. My worries, there are a few worries. The size of the problem is large, maybe $200 billion. There is not enough money for this. There are only, what, $5 or $10 billion available. How will we get the balance? And that's when we need the corporate bond market. That's where we need early and quick resolution. We need predictability. Points which, Renuka, you have raised, we need to get a quicker resolution. And we don't want the courts to come in and say that, okay, now homeowners, for instance, have a higher this thing stands over creditors. I mean, what has been stated, let's implement that. I also hear that there's a talk that you may replace the liquidation value with enterprise value. I mean, if we start doing these things, it will become very difficult to resolve issues. I take the case of the Kingfisher Villa. Originally, the value of Kingfisher Villa was put at, I think, 170 crores or something, 150 crores. 2 or 3 bids failed. Finally, it was sold for 70 crores. I think we need, we don't want to go through this process again and again. And as I said before, the ordinance, let's look at genuine promoters. So if you have a promoter which is backed by, let's say, a large private equity firm, they would have done the diligence. They will not have a fraud promoter to back. I think such cases, or where there are small promoters or small scale industries, we'll have to make some provisions so that it can go ahead. I think I've completed my 270 days.
No, thank you, Ajay. And I think what you said is absolutely true. Shift of balance of power is very defining, and in effect, a lot of Indian companies believe that banks were the ultimate private equity providers, with all the upside to the promoters and the downside to the bankers. That is how the system worked for a long time. And also this whole thing raised about, we have to be careful that we don't change the goalposts too much and too often as we go down this path, and much more sort of learn as we make frequent sort of changes. There will be changes, of course, because of the nature of the newness of the whole process. And before I go to Dr. Sahu, and I know Renuka, you've spoken, I would really go to you to get the ARC perspective, because you have been in the resolution process for the last few years, and also the challenges which that process has had, including one of the most important issues which I think the banks grappled with, which was, and which ARCs banks both grappled with, was how do you get a fair clearing price for the assets? And Ajay rightly raised also some of the valuations at which the system worked was completely artificial. Valuations given by so-called empaneled valuers were normally inflated so that more monies could be given in terms of lending. And there were some fundamental issues, including the valuations of the SRs or the security receipts which are sitting on the balance sheets of many, many ARCs, which I think have also an issue about inflation. So how do you go from the world of last 2 years to this new world, and what will change, and how do you implement this in real life as you see it, and as we know, you are amongst the largest holders of SRs in the Indian marketplace?
Yeah, thanks, Uday. I mean, it's a great piece of legislation as far as an asset reconstruction company is concerned. In fact, I have been a banker for nearly 4 decades now, so I have seen 3 cycles perhaps before this. In 1980s, in fact, Dr. Renuka actually, she touched upon that. In 1980s, we had BIFR. A legislation came with great hope, with a lot of good intentions. Then in the 90s, we have DRT. In 2000, we had SARFACI. And now we are in the early days of IBC. All legislations came with very good intentions and purposes. Somehow, as stakeholders, we didn't protect them. I think we as stakeholders should take blame for not protecting these legislations. I remember when BIFR was set up in IDBI, we had a separate cell to manage BIFR. But finally, I think it was hijacked by somebody. I mean, it became almost an asylum for unscrupulous promoters. DRTs could not be, developed into an institution. Even today, DRT takes 5-7 years for a resolution. SARFACI, we thought it would bring great opportunity for the lenders. SARFACI is still a good legislation, but for small loans. Maybe for a housing loan or for is a good legislation even today. But when you look at large assets, large factories, it's just ineffective. Why it's ineffective? Because even today, promoters can make it a law and order situation. So police will not interfere. Police will not help you to take over the asset if it comes to larger assets. So it is getting confined to smaller assets, housing loans and things like that. So this is a great piece of legislation, the IBC. We all have great hopes. Stakeholders, we need to protect this. That's our objective, our intention. As an ARC, I am a great stakeholder in this, because we look towards this legislation as a panacea for all our problems now. And it started off very well. It started off very well, and we are fortunate to have a regulator who is very receptive and responsive. Any problems quickly attended to. A government which is, this legislation should pick up and it gets perfected as early as possible. The greatest thing perhaps the government also did is to refer these cases to IBC, and these 12 cases are the most complex cases. So almost all issues of, we believe, all issues of the lenders would be resolved in one way or other, and judicial decisions will come, and it will get perfected very fast, because thanks to Dr. Sahu, the government of India, they are very keen that this legislation. Just coming to an ARC's role in the financial system. See, ARCs, just to give a briefly, ARCs came as an agent of a bank. So till 2014, perhaps they worked as an agent of the bank. So bank decided the price and bank decided the terms of the sale. So it was only an agent, as you had a very normal skin in the game with 5% and 95% security receipts. Security receipts is a hope note. If you recover, you pay that. So it was an agency. Great thing, Raghuram Rajan brought that great concept of a higher skin in the game for ARCs and right pricing by the bank. He wanted the banks to price the asset rightly and sell it to an ARC. That's a great move what he has done. So if the success of an ARC and the SR, security receipts, the value of security receipts should be seen in the context of this system of 1585. 1585 is not ARC is not an agent of a bank, because the management fee doesn't give you. In a 595 scenario, it was being an agent, it was driven by a management fee driven business. It's a great thing that it has changed into more cash, and Reserve Bank's intention is to move towards full cash, as is prevalent in all developed countries. Actually, in all developed countries, if you look at, bad assets are bought and sold at 15, 20, 30, 40, 30, not more than 30 cents per dollar. Whereas in India, that could not have happened because the banking system does not have capital to absorb the losses. They can't take the haircuts. As a via media for that, and if an asset which can be sold outright at say 30 cents per, an ARC can absorb it at around 35, 40 or 45 cents per dollar and recover maybe 75 cents per dollar out of that. Because in the 1585 structure, I just want to clarify to all of you, in a 1585 structure, unless you recover 160% of your acquisition value, you don't make your 18 to 20% IRR. An ARC system works in 18 to 20% IRR. You may ask why foreign funds are not coming to India. There is a different discussion altogether, because the comfort with the Indian legal system and the expected IRR of maybe 25 to 30%, the pricing may not be right. But for an ARC to get 18 to 20% IRR, I think what you need to recover is around 1.5 to 1.6% of your acquisition price. So for security receipts valuation, that way is right in the current sense. In fact, I just want to mention you, we have even acquired assets at 100%. It's all depend on the quality of the assets. If I acquire an asset at 100%, no haircut to the bank whatsoever, then also we make our IRR. It's a good business to be in. Because, just to give you an example of one of the ports in south, we acquired almost 100% of the debt at 100% cost. No haircut to the banks. We have restructured it at around 10%. If you really look at the management which you earn gives you around 10 to 12% IRR, and the debt is when restructured. When the debt is restructured at 10 or 11%, your 15%, your investment also earns that 10 to 15%. So you are home with 20% IRR. There are optionalities of equity, there are optionalities of if the economy picks up much better than what we envisage. I mean, your optionalities are very, very high. The good thing about security receipt structure is the bank continues to keep the option of upside in case it comes. So if the economy picks up, the assets which I acquired at 50 cents per dollar can get me even 100 cents per dollar.
Great.
Thank you.
Great. With that, I'll now request Dr. Sahu, maybe a little bit of the journey as you have seen till now, which is pre-intermission movie, but also
what Professor didn't introduce was that most of sitting on this side are partners in the same crime. Particularly Mr. Potak and Mr. Piramal, they sit on an advisory committee on corporate insolvency and resolution, and most of the output of IBBI you see today, what Renuka referred to as the 14 legislations, subordinate legislations, have the stamp of these two persons. So if things are not okay, you can find out the people whom to blame. The subject is the implication this IBC, one implication I just observed is that Bombay Stock Exchange has triggered insolvency resolution of 7 companies for non-payment of listing fees.
Yeah.
So this is very important since we are sitting in the NSE premises. At least the exchanges have found out one way of using IBC. Mr. CB mentioned about some decennial milestones. I look at it also, this reform, we have 3 major milestones. In the 90s, we focused on freedom to enter into business, primarily led by reforms in security. In the decade beginning 2000, looked at freedom at marketplace, freedom to compete, primarily reforms in competition laws. In this decade, freedom of exit, where the ultimate freedom in our economic sense, where we are looking at wherever the resources are stuck up, not being used, to find out a way of releasing them. So this is the freedom of exit, 3rd milestone. In the past 2 situations, we had enough experience. We had a security market, we had a competitive market, there were enough professionals, structure was there. But in this case, we are starting from a clean slate, absolutely no idea. IBBI, IP, NCLT, all of them have been created after enactment of the law, so no background knowledge. That is what requires us, though again in competition and security laws, securities, SEBI was set up in 1988. SEBI ordinance came in 1992. But SEBI, what we see today, the modern structure, security market laws, these came in by an ordinance in 95. So it took 3 years, 4 years. We had all the experience of fly-by-night operators, all those things we have seen, vanishing companies that still haunts us. Competition law came in 2001, but actual we saw implementation happening in 2009. So the only point I'm making is that there is a kind of a 2, 3, 4 year time where we may meander here and there a little bit, but as long as we are moving on the right track, and that is what we believe we have been doing, and that is what is requiring us to make frequent changes in rules or regulations and include. So one particular regulation, the corporate insolvency resolution process, which is at the heart of everything that is going on now. So that has been amended 3 times in this financial year itself, just to meet the demand of the participants. So whenever there is a demand for some regulatory change, our objective is that let us respond, and let's respond it in a very consultative manner. We go through a very detailed process of a consultation. I am not getting into that. But the point was being made about this, the objectives of the code. The very first objective as written in the long title is the maximization of the value of assets of the corporate debtor and for the purposes of availability credit, etc., etc. All the changes that have been made in the recent past, including ordinance, is only for the purpose of maximization of the value of assets of the corporate debtor. Here the objective is that we want the corporate debtor, if there is some enterprise value, if it is higher than the liquidation value, let us not kill the organization, preserve the organizational capital, let us make all possible efforts to resurrect it before taking a call that let it be liquidated. And that can happen only if we can have the right kind of people who can be entrusted with a distressed corporate entity for revival. The ordinance focuses only on that. Let's get a resolution plan which is actually grounded on the actual market circumstances and has been submitted by a person whom we can trust, who has a capability, who has a clean antecedents. In fact, the recent ordinance does not talk at all about promoter versus non-promoter. It only says that whosoever has the following disabilities is debated whether a promoter or not. In fact, somebody wrote a piece saying that every person by name Prem Chopra is not a villain. So every promoter is not bad. It's not promoter. There's no, the law nowhere uses the word promoter. It simply says, for example, if somebody has been debarred from security market, either accessing or trading in the security market, It could be promoter or it could be non-promoter. But the objective is that if he has been debarred, we can't expect him to come and run a company, again securities get listed in the stock market, again he will be debarred, and where does he get money to do the business if he can't access the securities market? So the that people are arguing that it will depress the valuation. It may depress valuation. I don't fully agree with that. Assuming so, we are focused on the value of the corporate debtor, not necessarily one set of stakeholders. And just because, again, in capital market, just because there is a possibility that value will be depressed, does not mean that we will allow Mr. Ketan Parekh to trade in the securities market. And what has been done is 5 people, 10 people have been kept out, while the market is the world market. Supply is actually from only one source, these companies which have gone into NCLT, but the demand is coming from entire world. The focus rather should be how do we create market environment where there is, in fact, I have seen Edelweiss people, they have already done quite a bit of interim finance. So how do we create markets where it is easy for insolvency resolution professional to raise interim finance to keep the company going? And after that, how do we get best resolution plan, create a market structure and provide the certainties, and wherever facilitation is required, lot of facilitation has already been done and still some are pending which are in the process. And then also look at the best way of selling the liquidation assets, so where we can get value. So the real solution is not that the ordinance is debarring somebody or not. We are looking at more people to participate. We are interested in a more liquid market where many people are participating. So if that is done, I don't think we have any problem, and our objective, we should maximize the value of assets. Thank you.
Great. Thank you, Dr. Sahu. And Renuka, you have any comments post your presentation on any of the points which have been discussed?
Well, I have a few things to say about what worries me about the process going forward. So in my presentation, I had alluded to, let's say, judicial interventions or how will the infrastructure develop, and just a few observations on what's going on that is kind of worrisome. So let me come to the question of, say, judicial decisions. So there are 3 recent decisions that stand out which perhaps we should discuss. One is this, the NCLT declaring that the 14-day time limit for admission of petitions is now not mandatory, or the Supreme Court allowing for settlement between 2 parties once they had entered IBC to now allow for settlement outside, or for the recent case where 75% vote is sort of lowered to 60% vote by, of the Committee of Creditors by the NCLT again. I think all of these cases.
Is there a judgment to that?
Yes, very recent. So now NCLT has said that, yes.
But that is against the law, isn't it?
Yes. So, well, they are inferring it to say that because, I think the judgment read that because the RBI allows the JLF to go with less than 75, this must be okay. But I think these kinds of decisions make me worried about where this process is going forward, and it's not aligned with the policy and legislative intent of the BLRC, and I think we should worry about where this process would go. Similarly, on the policy evolution, for example, the recent SC case of the public interest takeover of the company, that also is worrisome, or how we are going to.
Are you worried about the public interest takeover or the SC judgment?
The SC judgment.
No.
So, I mean, in the name of public interest, the takeover, the Unitech case that we have recently seen. So that also worries me. Similarly, there are some.
But SC judgment stopped it. So you think in public
no,
interest?
No, the NCLT has taken over the directors
That's
of.
correct, but Supreme Court stepped in.
Yes, that's right. So I'm talking about the NCLT part of it.
NCLT part.
Yes, that's right. And on the institutional infrastructure also, I think that there are a little concerns about the IU regulations or how the IP profession is shaping up. For example, we have barred foreigners from becoming IPs. We have in parallel the RBI setting up a public credit registry that sort of is at odds with an IU industry in the IBC setup. So I think these are all concerns that we have to address going forward, and if we don't address them, we might have a problem on our hands.
Yeah, I think any comments on Renuka's observations on change of the rules, or you think particularly this latest Jaiprakash, the Unitech situation. Ajay, how do you comment on that?
No, I think it's what Renuka is saying is right. We need, and especially but I guess it's evolving, and soon there should be clarity on it. That's the point. If we don't have clarity and every time it's subject to review by somebody else, then I don't think people will get the confidence, and you won't get investors coming in, Mike.
Yeah.
And we do need capital. I think there's no way we can manage the whole issue on our own.
I'll put up some questions here and maybe bring up some debate. The first question, the ordinance will again come to the parliament to be formally enacted as a law. Do we want any change in the ordinance? Any feedback by the group?
So may I?
Yeah.
So I think that the ordinance is very wide. Even if I were to agree with barring certain kinds of people, and that itself, is a question. Suppose I, agree with Dr. Sahu on the fact that we don't want certain kind of people in the game. I think the ordinance is very, very wide. It at least today seems to disbar pretty much everybody or many people in India certainly. The definitions of related party are very vague. It seems that almost everyone, and that is going to be a problem. So I think certainly, or we've debarred willful defaulters, but how the RBI calls somebody a willful defaulter, that process has not been reviewed. So it's a little difficult to just call someone a willful defaulter and disbar them from the process. So I think that a rethink on what those 8 categories are and how do we define them more narrowly is important, and define them to bid for what. I mean, one promoter or one person just bidding for his or her own firm or for every firm. I think that also requires a rethink.
I think I fully agree with her on one point. I would have loved if the decision of any type of resolution applicant to the COC, because COC knows everything. People are siphoned off funds, no, they should never be allowed to come in. But 1 year NPA, people associated with that, debarring, because NPA happens for factors beyond the control at some times. Perhaps that should have been left to the COC. Maybe, see, even in COC, some evaluation criteria is getting evolved. It's getting evolved. Actually, perhaps, I mean, it's only a wild thought. An existing promoter who have brought affairs, if he gives a resolution plan, start with a minus 25 marks. I mean, but give a chance. We are thinking of only these 12 large cases or maybe another 25 cases after that, where some quality assets are there. There could be good strategic attraction, strategic interest in those cases. But there are hundreds of cases with the banking system where you do not have a strategic interest. Medium, smaller cases, I mean, all will finally, if it goes to NCLT, it will have to go to liquidation.
Ajay, what are your thoughts? What are the changes you would like to see in the ordinance? Are you happy?
No, I think I actually agree with this, and this is what I said earlier also. So there is a moral hazard. If in the large cases, if you know that there is a clear diversion of funds, and if you allow the same promoter to come, and frankly, in a large number of assets, you're not going to get 100% of the value. In the books of the bank, a lot of the assets are inflated because you keep adding interest on interest and interest. Who's going to pay for that? And then if you see that I'm going to give an asset at 50%, which may be the real value, I think that will never sell. And we are seeing large loans. So to say, therefore we'll have to segregate. But on the other hand, what Mr. Anthony said is also true. Small and medium industries may not get anybody else to come. And some people genuinely have had issues in the business, maybe and the environment was bad or whatever be the reason. So should they be barred? No. So it's actually a very difficult and delicate thing. It needs definitely some change, because today, even if a private equity person has invested in a firm which has become an NPA, that person cannot invest in another project, in another resolution. So I guess it still needs more thought, but that you should bar some promoters has to be, otherwise it will not go through. I don't see any government, any parliament passing this thing. So we need to recognize it, and there is a moral hazard.
Yeah,
Do you want
the right point that there is a big moral hazard here. Do we want to repeat a cycle that somebody defaults, comes to this process, gives a haircut to the bankers, takes the company? After 3 years, he knows this is the rule of the game. So after 3 years, again he will commit default, again go to NCLT, again 50% discount. So till, of course, if you every time discount by 50%, you will never reach zero, but you can approach zero. So is that the message we want to give? And can we discriminate, say that no, I want to follow the rules for big enterprises, but for small enterprise, I don't care? I don't think that kind of rule is permissible. And to me, I think it's maybe more difficult to get a resolution applicants for big enterprises, because that requires huge resources. But for small and medium enterprises, very likely you will get more enterprising people, more resolution applicants actually. So I don't actually subscribe to that view. But the point you made is that you give another additional 25% premium. How does it work? The guy who is mischievous, he will come back and always say, why 100? I will give you 150.
Yeah.
And you can't say, no, your 150 is not reliable. And the guy who is more realistic, who wants to really give the company, he will come with 90 rupees. So if the market is always ahead of you. If market knows that you are discounting whatever a 10% gives by 25%, so then he will inflate by 50%. So I don't think that is the solution, but you have to look at what is the basic objective we are trying to achieve.
Oh, one of the things which I understand is why this rule came in, because within the policy framework, and there has been too much of a perception that it has been a fixed match between promoters, ARCs and banks. And too much of that was actually going around, which is why I think something like this came in, where effectively the system is saying that this needs to be changed. And even in this whole area of willful defaulters, there are many, many companies where the promoters have not been made willful defaulters, but there has been use and misuse of monies in those companies, but not formally converted into willful defaulters. So I think it's a very difficult balance between the two. And my personal view is, and maybe we can comment on this, is assuming in the first round you get one bidder or zero bidders, should there be a way in those situations that if there is a second round, should we sort of allow promoters in if the first round gets only one bidder or zero bidders? Again, a question to the...
So one of the concerns I also have is that if a existing promoter wants to bid, will you really get...
No, first round, no bidding.
Yeah.
But assuming...
Even the person knowing that, okay, let's make the first round unsuccessful.
Can they do
some?
It?
Yeah, no. So because sometimes they have links within. I don't know. I'm just now speculating. No, I'm really not sure of it.
Friends and others will be told, hey, don't bid for this, okay?
No, it's not friends and others. I think the full information, I don't know if it will be available to all the bidders or some incorrect, I don't know.
But Ajay, let me ask the reverse. How would, from the point of view of propriety, a committee of creditors has to decide where it's only one bidder. What happens? Would that be, should that bid be accepted, not accepted? How would you ensure transparency? What happens?
No.
And in many assets you could steer.
Absolutely, this is an issue.
Yeah,
if
it is an issue. I don't have a solution yet. I think we have to address a lot of these issues. So I don't, it's a sensitive issue, it's an important issue, needs to be, but I don't have an answer yet to all that.
What I meant was a minus mark for the promoter's bid. That's why I said it. The evaluation criteria is being evolved like this: upfront cash, NPV. Before that, minus 25 marks, because upfront cash has 30 marks, maybe NPV has 30 marks.
But how do you enact it as a law? That is the problem.
No, it's an evaluation criteria left to the COC.
Renuka, your thoughts on this? Assuming you get only one bidder, how do you handle this?
But I think it should be left to the committee of creditors
And to give it to that one bidder.
Or they will go into liquidation and see, what if that one bidder is better than liquidation, then you go for that one bidder, or you go for liquidation. I feel that it's not for us to, be making or
no, with the promoter not being allowed, and you get only one bidder.
So it's a commercial decision that the committee of creditors makes. So I would stick with the IBC intent and say, it is what it is, and make a choice.
There's no scope for a second bid. It's only 75% comes.
No, but what happens if COC doesn't agree? Then you have to have a second bid, no?
If
liquidation. Actually, it goes into liquidation.
If you
no,
cross
as long as it's within the time.
Yeah.
Okay, the next question, and this is again much more.
So the solution is not that allow a tainted person to come in. Solution is create a market which obviates this problem for all times to come. So focus on that, creating a market for resolution plans. But as of now, ordinance says that if SIS on the date of the ordinance, if there is not enough or not a good proposal, or there is not a proposal from an untainted person, so it allows you to make one more bid, one more invitation. It allows as it is.
So I think the only thing that I worry about here is classifying someone as tainted is a little difficult. So while we have some 8 criteria, even then whether this was, maybe for these 12 or maybe for the first 20, we know, as you said, that this was problematic, but it's hard to know beforehand from these criteria whether this was intentionally done so or not. And I think my sense would be to not be moralistic about where the promoter comes from.
Okay, I'll move to another subject in this context is, finally, as Dr. Sahu said, that we are trying to get maximization of value for the creditors.
It is not moralistic at all.
Not moralistic.
Not moralistic at all.
If I ask the view around this panel, and obviously I'll subsequently open it up to the group here, and we are talking about very illiquid assets, okay? So and what is fair value is difficult to do. But as we see resolution over the next 6 months, in the next 6 months it will be much more about perception rather than reality. And if we did a view 3 years later, and 6 months and 3 years, I'm bringing 2 time frames, do you think fair value will be achieved? The buyer will do better, or the creditors will do better through this process?
Okay, this is actually, I look at it that this will bring huge behavioral changes in the people. If as a debtor I know that if I default, the process will take me to in this manner. This is the clear defined path. So I will do the best to avoid this trap. So also creditor also, while sanction the loan, they
that
will,
I agree. So good behavior, conduct, shifting, I agree, Dr. Sahu.
Yeah.
But for these assets which come in, finally the objective is fair value, where the creditors maximize their price and the buyer doesn't lose. I mean, or should not lose.
There I am not agreeing. I am saying that there are many stakeholders. Creditor is of course the most important stakeholder at this situation. But I am looking at the company should survive, the enterprise value should survive.
Resolution.
If that does not happen, taking care of interest of one set of people is not adequate, that defeats, then the creditor could have gone for a recovery route.
That's correct.
When he has chosen to this is a collective approach to find out a solution.
So
not that you run away with your share of a place and leave it bleeding and so that the company is never resolved.
Therefore, if I hear what you're saying is, not only should creditors get a good deal, but the buyers should be able to resolve and transform these to create value.
This is essentially a corporate.
That's correct.
Corporate means it's an amalgam of interests of various stakeholders. So just because today creditors in charge does not mean that it has lost the character of a corporate.
That's correct.
So it should continue in corporate being a legal person, should continue in perpetuity and must take care of the interest of all stakeholders.
Ajay, keeping in mind your view that capital is scarce and the supply is a lot more, logically, scarce capital,
it has to make a decent return, otherwise nobody is going to come as much as we want. And I think Dr. Sahu's point is right. Price has to be actually has to give a return. And to your point, whether will the creditor get more, will the buyer get more, I think it depends on assets. So like we have seen a few assets. Some of them are definitely good and will probably, the creditors will get what they want. I think talking of behavior, a big change will be, I think creditors will push the debtors to actually settle quickly or get a resolution with the threat of going to IBC. Very often there is decay in the value of asset over time. So it's better to solve the issue. If you have a problem, it's like cancer. At the first stage you tackle it, it can get cured in most cases. But if you wait till terminal stage, then there's no cure. So I think all creditors till now are actually pushing the credit, somebody else will do it. Now they'll have to settle. So that is one thing. And I think there they'll get higher value. But ultimately, will the creditor get more or the debtor or the buyer? It really depends on each asset. Where there is a lot of, I mean, I've seen some assets where, the working capital is so inflated. They don't have those, they don't have either the receivables, they don't have the inventory, and banks have valued it. You think they'll get value? No. I mean,
That's right.
I'll just shift another subject. Now that with the ordinance as it stands, the promoters cannot bid. Therefore, let's see, we are talking about somewhere around 12, 13, 14 lakh crores of assets. And most of them will go down the IBC route. And if in most of these cases, promoters lose the companies or existing board and others lose these companies, how do we see operating management or replacement of operating management and the potential bidders, and looks like a lot of them are going to be institutional, partnering with some. How do we see operational and operating management being put in place in these situations? And there's going to be a hell of a lot of this coming out. So how does that work, and do you see risks around that?
Actually, this is one area which needs to be developed in this country. Unfortunately, in our situations, promoter and management is the same. So if you want to change the management, you need to dislodge the promoter. And the first time, fortunately, IBC has brought that capability. We can do that. But what we need to develop is a professional operating company, operating partners, along with maybe private equity or an asset reconstruction companies. They should be able to operate it. But there also challenges will be there because it's a different cup of tea. Running a company is a different.
No, I see a lot of some of the bankers here, and they've tried to, in many cases, implement through S4A and others 51%. And I don't think it's been easy to get operating management in terms of running these companies. So if you have such a large number of companies coming in and primarily financial builders with some strategic partners, isn't there a risk that this is something which needs to be focused on, or you see a whole new cadre of professional entrepreneurial managers coming in and building a whole new way of...
So my view in this is, first of all, there will be consolidation. I think the successful bigger players will get larger. In the world, this is what's happened everywhere. It's going to happen here, and it's good. If the company has gone sick and has gone to such a bad state, I think the promoters, the manager should not be there. Anybody should be better than that. I think why are we... So that's one. And second, I think that there are good professionals available now in the country. It's not there. You can get professionals from abroad. I've seen people getting that. Actually, the salaries and all that, if you have a good package in India today, it's as good as anywhere else. So you can get that. And therefore, the way we are approaching this is that not only financial, I don't think financial solution is enough. You have to have operational. So either you partner with somebody who's who has deep knowledge of that industry and has a successful track record, or you yourself may have done it, or you can hire management. What else do private equity firms do and get good returns? So I think we should not worry unnecessarily about that. If somebody is going to put so much money, they will find a solution.
No, I think.
But who is asking you? Who is asking you to throw away the existing management? All key managerial people, all those who are there from day one, they start reporting to IRP, RP, then the new management comes in. What change happens is maybe only at a board level also. So you have the choice of continuing with those people or take a different set of people. So I don't see any crisis in that.
So with that, I'll just add my last two bits. First, I completely agree that in many ways, the formation of the Insolvency and Bankruptcy Code is about preservation, development and growth of national assets, a lot of them which have got stuck and are therefore not performing to produce returns for the country. And I think that is the larger purpose of this whole enactment, to really make these assets perform and produce for the benefit of users and creation of value for the nation. That's the broad overriding approach of this. And within that, I think we are going through, as I said at the beginning of my discussion, that we are going through this period where this is like a Bollywood movie. We are at intermission stage, and as they say, picture abhi baki hai. So with that, let's wrap this up.